Bismillahirrahmanirrahim. My name is Hassan and welcome back everyone. Those of you guys who have fasted in the last month, Eid Mubarak to you guys, and hopefully you guys had a beneficial, productive Ramadan. This is my Robinhood portfolio. Currently it is around $38,000 and these are some of the companies that I'm holding on to on the right. Today I'm going to give you guys a stock analysis video on a under the radar tech company hardly anyone else is talking about. It's called Garmin, ticker symbol GRMN. This company is going to grow really well, slow and steady. I like to call these companies sleep well at night. This company has very little short and long-term debt. If we scroll down, we can see that their total debt is around $74 million. In comparison to their cash that they have, around almost $2 billion, it's very little. If they want to, they can literally pay off this debt all at once. This debt that they have, it's not generating them interest. I consider bad debt as anything that generates interest that you have to pay for in the near term. As if you're not paying interest for it, it's fine if you have it short term. As always, don't forget to check out the disclaimer in the description below. So now I want to take you guys back to my Robinhood portfolio, currently around $38,000. For the 1 day, it's up around 2.7%. Click on it for 1 week, I'm down around 2%, and then if we click on it for the 1 month, I'm up around 2.2%. For 3 months, it's up around 2.5%, and then for the 1 year, I'm up around almost 39% or almost 40% for the year. And the reason why I'm showing you guys my portfolio is because if you guys are going to follow somebody, if you're going to listen to somebody, they should have a credential. They should have a proven track record where they are very transparent with you and they can show you all their gains and losses. That way we're listening to somebody who is credible, who has a proven track record, not just blindly following some YouTuber who's not showing his portfolio. I am having a nice capital appreciation, but this portfolio with companies such as KL, AMD, Texas Instruments, Polaris, MMP, Contour Brands, NVIDIA, 3M, Johnson & Johnson, they generate a decent amount of dividends. If we click on filter by dividends, we can see that every few days I'm receiving dividend payments, such as in June I'll receive Marine Products will give me $5, $9, Pfizer, A.O. Smith, $2, Texas Instrument, $11, MMP, $42, Colgate, $2, and then April, $5, $2, $3, $6. These dividends, yes, they are a small amount, but over time, they add up to a good amount in dividend income. Another thing I want to point out is that this is a stock analysis video for Garmin. I do want to point out some of the stock analysis video I made in the past just to show a little bit more of my credibility. This is my 12th year investing in the stock market since like around 2009. So we can see these are some of the videos I made in 2019 and 2020. You can see Broadcom, Waste Management, Pets, Texas Instruments, Cisco, Skyworks Solution, Johnson & Johnson. All these companies, for the most part, besides Johnson & Johnson, they're up massively, which is a good sign. And I think that Garmin should also continue on this path and continue to do well in the long term. Remember, I'm a long-term investor, long-term dividend growth investor who are investing capital appreciation and the dividends as a bonus. Remember, we don't get rich off the dividends. We do get rich off the capital appreciation. Just the dividend just reinforces and keeps everything calm. So I do want to point out one of the cool apps that I use is called Fetch Reward. It's a pretty awesome app. You go to the store, you buy something and you scan the receipts and you get points. And with those points, you can redeem gift cards from Walmart, Amazon, or Target. Pretty much you get paid to shop and you get paid through these gift cards. There's a link in the description. If you use my link, you get some points, I get some points. It's a win-win situation. It's a really good app. If it wasn't this good, I wouldn't be promoting it. We're back at Seeking Alpha, Garmin. So Garmin is pretty much designs, develops, manufactures, markets, and distributes range of navigation, communication, and information devices in North and South America, Asia, Australia, Europe, Middle East, and in Africa. You don't want all your investments to be in one specific continent. If you're diversified, it reduces your risk and you can get market share from all over the continents, all over the world, not just one specific area. Quarterly report, we can see here that their revenue is broken up into 5 sectors such as fitness, outdoors, marine, aviation, and automotive. Scroll down, we can see the last 3 years data, we can see that fitness is increasing, outdoors activity is increasing, marine products are increasing, their aviation is pretty much standing still, and their automotive is decreasing. And this is because Garmin is very well known for their navigation system, and we don't use a GPS anymore. We use a GPS on our phone. So that's why this is decreasing. So out of the 5, we have 3 that is increasing, 1 is staying still, and 1 is decreasing. And I would say that's a decent amount of growth, because if these 3 can continue to growing, company will eventually continue to do well, and they will appreciate in share value. So quickly, I want to take you guys to their website. We can see some of the products that they have, their fitness, smartwatches, navigation. We can see their automotive, GPS, their sports and fitness, their outdoor recreation, and their marine products, and lastly, their aviation products. So the website is very well designed. If you guys use any of their products, let me know in the description. Tell me what you guys think. So again, we're going to take you guys back to Seeking Alpha. So Seeking Alpha is like one of the great tools or websites to do stock analysis. If you haven't created an account, it's free to do so. Instead of looking at the price, we try to look at the company, and that's more important, because if the company is doing well, the price will follow. If the company is doing bad, the price will also follow. As long as we are focusing on the company, our capital appreciation or the share price should do well. One of the first things I like to look at is their market cap. Market cap is currently around $26 billion. If I were to buy this company all at once as a whole, I would have to pay $26.5 billion to buy this company. Their PE is around 25. It's actually a little bit higher than what I like to pay. I like to pay for companies with PE ratio of 20 or below, but this company is growing, so that's why we have to pay for it at a premium. That's why I said don't lump sum into this company. I'm dollar cost averaging slowly into the company, acquiring more shares as the price increase or any dip we see in the market. I do want to point out that comparison to their industry, their outstanding share is 192 million. This is relatively low, which is a good sign. If the share counts are low, that means they have room to grow. I just like to have a larger piece of the pie. As long as share counts are staying low, that's a very positive sign. Another thing I want to point out is that insiders, 26%. So the company's owners, one of the originators, most of them, they're holding on to around 26%. This shows if the insiders are still in the company, that means the company is still doing, because they hear about the news before everybody. If they're running out in a massive way, that's a big red flag. And if they're buying more shares or acquiring more in the company, that's a positive sign. We can see here they currently own around 26% of the company. Next thing I like to look at is their net margin. Is the company making money? A lot of times we invest in companies that are only making 10-15% in net income, which is very little. So if the company does bad for one quarter, one semester, they lose a lot of their gains because their profit margin is so low. Here, they have about 24%, almost a quarter of their revenue is in income, which is a very positive sign. That means the company is generating huge amount of cash. And that shows that they have 4.4 billion and their income is around 1 billion, 1.05 billion. Almost a quarter of it is in net income, which is a very positive sign. Next thing I like to look at is their current ratio to see how well the management is doing and how well the company is running. So the current ratio is around 3.8, which is excellent, great sign that the company is really well funded. So I want to talk a little bit about current ratio because this is a really important concept as an investor to understand. Current ratio is pretty much current assets divided by current liabilities. We all know what assets are. Current liabilities is pretty much the company's short-term financial obligations within the next 1 year. So current liabilities include accounts payable, expenses, short-term debt, dividends, notes payable, as well as income tax. These are obligations that the company has to pay within 1 year. So the company having a current ratio about 3.8 shows that they are very well funded for the next few years and they are very well managed. And this is one of the ways how I look at how the management is doing. Continue to look deeper into the company. If we look at their revenue, in 2016, they had a revenue around $3 billion. Fast forward to December 2020, they had a revenue amount of $4.2 billion. And we can see in 2021, they'll have 4.7, 2022, they'll have about $1 billion. We can see a nice steady increase year after year. This is showing that the company is doing well. The company is generating more revenue year after year. This is a very positive sign. Remember, if the company is growing, that means their share prices will also grow. As an investor, we like to relax, earn our dividends, and earn our revenue in a nice, comfortable way. And every time it dips, this is a great opportunity to buy a great company at a great price. Guys, if you made it this far, hit the subscribe button, hit the like button. Remember, and I said this before, in the investing world, we're all on the same team. We're trying to generate our wealth or increase our wealth as much as possible. We're not against each other. We're actually on the same team. So we can see here their revenue is increasing year after year. And if we scroll down a little bit, we can see that gross profit is also increasing year after year. And this is a very positive sign. So let's look into the future a little bit. And if we scroll down here, they give us some earning estimates for 2020, 22, 23. In 2021, they expect around 5.37 cents earning per share. 2023, they expect $6.59. We can see that their earnings, not their revenue, their earnings is increasing around, you can see 4%, 10%, and then almost 12% for 2023. And this is a, yes, slow and steady wins the race. We can see here Garmin for the chart. The last 1 year, it's up around almost 76%. Let's go to the charting really quickly. And we're going to compare our Garmin, ticker symbol GRMN, with the S&P 500, because this is a base mark we all like to compare ourselves with. So here I put total return. This total return includes that the dividends are being reinvested, which is really important because they are providing us with dividends, and this shows a little bit more accurate data. So we can see in the last 1 year, it's up around 80%, and the S&P 500 is up around 48%. And if we continue on with 3 years, we can see that S&P 500 is up around 57%, while Garmin is up around 150%. And if we look at it for 5 years, we can see that Garmin is up around 300%, while the S&P 500 is up around 121%. In the last 5 years, it has been beating the S&P 500 year after year, and I think that they will continue to beat them in the coming years. I can ask a 5th grader or a 9th grader and ask them, hey, based on this trend, where do you think Garmin will go next? And obviously, they follow the trend line. They will say, yes, it's going to continue to go up. And not only is it going to continue to go up, it's going to continue to beat the S&P 500 like it has been beating the last 5 years. Yes, no one can predict the future, but this shows us an accurate estimate that we think with all the data that is presented to us, we can assume or take a prediction that it will go higher. And one last thing, guys, I do want to point out as a Muslim investor, we have to take a look at the interest expense, which is extremely important. And here we can see the interest expense for the last few years, it has been 0, which is a very, very positive sign, because that's what we want. We want to invest in companies that do not pay interest. Just like as a individual, when we swipe our credit card, we don't like to pay interest. If the company is not paying interest, that is a very, very healthy sign that the company is doing things right and that they're not over leveraging themselves and they are doing the right thing, because no one likes to pay extra expense. And especially as a Muslim investor, we should stay away from paying interest or receiving interest at all. I do want to point out that they do have some cash which generates them around $32 million interest revenue. So let's pull out the calculator. So we're going to do 32 divided by their gross profit, 2,616. And we're going to times this by 100 to get our percentage. And we can see around that their interest income is about 1.2% of their gross profit, which is less than their 5% according to some of the Sharia compliance. So yes, we want it to be 0, but this is what we have for now. Hopefully that they get rid of these interest income or they invest it so that way they're not receiving their interest income. And some of the things we want to look at as Sharia compliance, we want to look at companies that are halal, that are not paying interest expense, or at least the interest expense is not exceeding more than 5% of their gross profit, and their haram revenues are not exceeding 5% of their total revenue. Cash and interest-bearing items are less than 32%. Interest-bearing debt is less than 30%. So their debt, interest-bearing debt is good, pretty much 0. the company overall seems halal and they're not paying anything in interest expense. They do have some haram revenues in terms of interest income, which is still less than 5% of their revenue and 5% of their gross profit. As always, guys, if you made it this far, please hit the like button, hit the subscribe button. Thank you. See you guys next time. Bye, everyone.